Imagine you're at a dinner party, and you overhear someone boasting, "I manage my retirement savings just like Yale University handles its billions." Sounds impressive, right? But what does it actually mean, and more importantly, could it work for regular folks like us? Today, we're diving into the fascinating world of the Yale Endowment investing strategy. Get comfortable, folks, and let's explore how the investment strategies of the Ivy League elite might just revolutionize how you think about your own retirement savings. This is the Finance Virtuoso channel, where we talk about all things finance. If you're new here, be sure to subscribe and hit the notification bell so you don't miss out on any future money tips and tricks. Let's start with the basics. What exactly is an endowment fund? Simply put, it's a big pool of money that organizations like universities, hospitals, or charities use to fund their operations. The goal is to make this money last, well, forever. And that's where things get interesting. Yale's endowment is particularly famous in the investing world. They've developed a unique approach to withdrawing money from their investments each year. Now, before we get into the nitty-gritty, let me be clear, we're not just talking about Yale here. We're exploring whether their strategy could work for regular folks like us who are trying to make our retirement savings last. So, how does Yale decide how much to withdraw each year? They use a formula that looks at 1. How much they withdrew last year. 2. The current market value of their investments. 3. Their target withdrawal rate, which is currently 5.25%. They take 80% of last year's withdrawal, add 20% of their target rate applied to the current market value, and adjust for inflation and taxes. Don't worry if that sounds complicated. The key thing to understand is that it's a flexible approach that changes based on market conditions. Now, Yale also sets some limits. They never withdraw less than 4% or more than 6.5% of their endowment's current value in a given year. This helps prevent wild swings in their spending. So, why is this interesting for us regular folks? Well, it's all about finding that sweet spot between 1. Withdrawing enough to live comfortably. 2. Not running out of money before we kick the bucket. Let's compare Yale's approach to the classic 4% rule that many retirees use. The 4% rule says you can withdraw 4% of your initial nest egg in your first year of retirement, then adjust that amount for inflation each year after. It's simple and has worked well historically, but it's not perfect. Here's where things get juicy. When we look at how these two strategies would have performed over the past century or so, we see some interesting patterns. 1. Income generation. On average, the 4% rule actually produced more income over a 30-year retirement period. But, and this is a big but, the Yale approach had higher peaks when markets were doing well. In good years, it could generate up to $125,000 from a $1 million portfolio, compared to a steady $40,000 with the 4% rule. 2. Risk of running out of money. This is where the Yale approach shines. Because it adjusts based on market value, it's theoretically almost impossible to completely deplete your savings. The 4% rule, on the other hand, can lead to running out of money in some historical scenarios. 3. Income stability. Here, the 4% rule wins hands down. Your income changes predictably with inflation. The Yale approach can lead to income swings of 20 to 30% from year to year. That's great when it's an increase, not so fun when it's a decrease. 4. Maintaining buying power. This depends a lot on how you invest. With a more aggressive stock-heavy portfolio, the Yale approach might actually increase your buying power over time. But with a conservative mix, it could struggle to keep up with inflation. Now, let's tackle the elephant in the room. Is this Yale strategy actually practical for regular retirees? There are some challenges. 1. Complexity. It's not exactly simple to calculate. You'd need to be comfortable with spreadsheets or use specialized software. 2. Emotional roller coaster. Can you handle your income dropping by 20% in a bad market year? Many people would find this stressful. 3. Minimum income needs. If you have fixed expenses that require a certain minimum income, the Yale approach might not work for you in severe market downturns. But here's my unique take on this. I think there's a middle ground that could work really well for many retirees. What if we combined elements of both approaches? Imagine this: you start with the 4% rule as your baseline. This gives you a stable, predictable income floor. But then, you add a Yale-inspired flexible component on top. In good market years, you allow yourself to withdraw a bit extra, maybe for a dream vacation or to help out family. In bad years, you stick closer to your 4% baseline. This hybrid approach could give you the best of both worlds. 1. A reliable minimum income to cover your essential expenses. 2. The ability to benefit from market upswings. 3. Some built-in protection against depleting your savings too quickly. Of course, this isn't one-size-fits-all advice. Your perfect withdrawal strategy depends on factors like the size of your nest egg, your essential expenses versus discretionary spending, your risk tolerance, your other sources of retirement income, like Social Security or pensions. Here's another thought. What if we applied the Yale philosophy to our saving years, not just our spending years? The core idea is flexibility and adjusting based on market conditions. During your working years, you could set a baseline savings rate, but then boost it significantly in years when your investments perform well. This approach acknowledges a fundamental truth about markets and life: things change. The Yale strategy, at its core, is about adapting to those changes rather than sticking to a rigid rule. Now, I want to hear from you. Does this Yale-inspired approach intrigue you? Or do you prefer the simplicity of something like the 4% rule? Drop your thoughts in the comments below. Before we wrap up, let's recap the key takeaways. 1. The Yale Endowment strategy offers more potential upside in good market years but less stability than fixed withdrawal methods. 2. It's theoretically safer in terms of not depleting your savings, but requires the ability to adjust your lifestyle with market swings. 3. A hybrid approach, combining a stable base withdrawal with a flexible additional component, could offer a compelling middle ground for many retirees. 4. The core philosophy of flexibility and market responsiveness can be applied to both saving and spending strategies. Remember, the goal isn't to blindly copy Yale's approach. It's to understand the principles behind it and see how they might apply to your own financial life. Whether you're just starting to save for retirement or you're already there, thinking critically about withdrawal strategies is crucial. That's all for today, folks. If you found this helpful, please give the video a thumbs up and consider subscribing for more financial insights. And remember, while we can learn a lot from institutions like Yale, your retirement strategy should ultimately be tailored to your unique situation and goals. Stay curious, stay flexible, and keep learning about your money. See you in the next video.